But as we move from the 10K net worth to the $1 million net worth to the $1 billion net worth, you'll see that primary residence is a smaller portion of your net worth. How many primary homes are you going to have? And retirement accounts are a smaller portion of your net worth as well. What continues to grow is stock portfolio slightly, but more so business interests. So we've all talked about we all know stock market investing, but what we all don't know as much is investing into private businesses. And that's what we focus on at Clive Capital is investing into these private businesses because we see that those who are worth 10 million, 100 million, $1 billion, ultra high net worth, more and more as your net worth increases, your allocation into private businesses is the largest component of your investment portfolio. Hey everyone, thank you for joining our webinar today. My name is Keshav Kulor, founder and principal of Clive Capital, and I'm joined here by my partner John Lai.
Hi, everyone.
And today we're going to talk to you about the minds of $10 million fund managers. So we ourselves at Clive Capital are excitingly approaching the long-awaited $10 million assets under management, investor capital under management milestone. And so we wanted to take this moment to really celebrate and put our thoughts just into a more formal document and a podcast episode here about how we are evaluating investments for ourselves, but also for our investors and the $10 million roughly that they have entrusted with us. Okay, so our agenda today, we're going to quickly go through Clive Capital and our backgrounds as well, discuss the investment process when it comes to sourcing opportunities and doing the due diligence on them. We're going to talk about portfolio construction and risk, and we'll end with Q&A and discussions. So, quick disclaimer, all of this material here is just for educational purposes only. We're not tax, investment, financial, any such advisors, legal advisors. And we always recommend that you consult your own professionals, the professionals in your life, before you make any such decisions. Okay, so the Clive Capital team. So, Clive Capital, what do we do? We underwrite and invest into institutional level opportunities worth tens to hundreds of millions of dollars, allowing fund members to passively invest as little as $50,000 without having to take on a second job as a full-time investor. And our larger than life goal is to help 10,000 families achieve financial independence through a diversified portfolio of such investments. Quick background on me. I made my first investment into a 108 unit apartment building in San Antonio, Texas in September of 2021. And after seeing the success with that, I decided, hey, this is how I'm going to manage my wealth, and I want to help my friends and family, coworkers, etc., manage their wealth this way as well. So started Clive Capital in January of 2022. And we work with the brightest and the best in each of the industries that we're in to provide passive investment opportunities to our investors. And yeah, my corporate background includes working at some of the largest companies, including Amazon and Meta.
And a little bit about me. I came from the corporate world as well, working firstly in accounting and then transitioned to consulting, eventually into finance, and then back into high tech. So I don't know what journey that is, but it is a journey. And all along the way, I've been interested in investing in real estate, initially in residential, and then about 5 to 7 years ago, more in commercial, just because I see much more value and scalability in commercial real estate. I started with multifamily, built to rent, then into private credit, eventually into oil and gas. And when we're expanding into other asset classes, as our evolution has expanded into different needs. And then as we see our investor base, and we'll talk about this as well, as our investor base expands into different age ranges, different kind of parts of their lives, so stages of their lives. So you'll see that in some of what we talked about today.
Great. And so now jumping into the investment process, it's about understanding yourself, right? And for us, it's about understanding our investors. So one important indicating factor that really affects how we approach investments, tech strategies, finances is how old we are, right? When we're earlier on 20s and 30s, we can take a lot more risks. And that means that we can invest into riskier ventures like hedge funds, for example, venture capital, etc. And so that's why it's a very aggressive portfolio, really focused on growth investments, the upside story. As we enter into the 40s and 50s, those are our peak earning years. That's when we start looking a little bit more towards retirement. How do we mitigate our taxes now that we are earning so well? And medical expenses coverage for us and our loved ones, right? Our family at this point, we might be married, have kids, etc. And we're a little less aggressive now because we have kids. So we can't just YOLO into some Wall Street memes stock or a crypto coin. But a lot of the fundamentals stay the same in terms of finding growth assets, passive income generating assets, and assets that are more tax advantaged. And then as you get closer to 60, 70, you start getting to retirement age. There, your financial objective is less about the upside story, and it's a lot more about how do I predictably maintain what I have built and then pass it on to my loved ones or the causes that I care about. Your risk profile is typically more conservative. And at this point, instead of investing into a hedge fund or into venture capital, you're investing into more private lending, private credit, into bonds, CDs, equities, maybe some real estate as well. And so this is something that we prioritize when we're talking to our investors, existing and new, is where in life are they? What are their financial objectives? And these are the same questions that you as an investor should be asking as well before you start looking at any investment is what am I trying to get out of an investment?
Yeah, and what we find with a lot of our investors is that they might you're coming from the W-2 world, and so you're exposed to a lot of the public markets, equities, maybe some bonds, but not much else. And it's really eye-opening to be able to see different types of investments outside of that, and chiefly private equity, but also hedge funds and the like, that the ultra rich, frankly, have been exposed to. So we want to expose our investor base to all those, the plethora, the wealth of opportunities that they could invest in before they get to an age where, and maybe an income base where they can start looking into that. So we're excited to be able to share that with you.
Okay, so age is one important factor in terms of how you're evaluating investments, but your net worth is as well, right? When you are just starting out at a 10K net worth, and we've all been there, you cannot take the Hail Mary bets, right? You can't just risk it all in one investment because that's all you might get is just one investment. So that's why that's important to consider as well. And you'll see that the typical investor, less than $1 million net worth, most of their net worth is tied up in their primary residence and their retirement accounts, right? Their stock portfolio might not be that much. This might be obviously different depending on your net worth. If you're closer to that 10 million bracket range, your stock portfolio is a considerable amount. But as we move from the 10K net worth to the $1 million net worth to the $1 billion net worth, you'll see that primary residence is a smaller portion of your net worth. How many primary homes are you going to have? And retirement accounts are a smaller portion of your net worth as well. What continues to grow is stock portfolio slightly, but more so business interests. Okay, so we've all talked about we all know stock market investing, but what we all don't know as much is investing into private businesses. And that's what we focus on at Clive Capital is investing into these private businesses because we see that those who are worth 10 million, 100 million, $1 billion, ultra high net worth, more and more as your net worth increases, your allocation into private businesses is the largest component of your investment portfolio. And when we say business interests, that can include small businesses. It could include real estate, private lending, oil and gas, all of these things that we do. That is not just residential real estate or your primary house.
Yeah. And
And it's, go ahead.
go ahead. No, go ahead.
I was going to say that's seeing this graph. This is how we position our investment portfolio as well, is when you want to get good at something, you look at what other professionals are doing. We see that the professionals, the people who are billionaires, are putting their money into businesses, whether it be their own or someone else's. And so that's what we want to do as well.
What I was going to say is, if you look at the transition between 1 million and 10 million, that what stands out is that yellow portion, the retirement accounts, shrinks pretty dramatically, right? And then, of course, the businesses increase pretty dramatically, but it does shrink. And so it's interesting. Obviously, stocks, as you earn more, potentially you will be able to invest more and that'll grow. But because the retirement accounts shrink, that is pretty telling. Now, we do have ways, of course, to invest your retirement accounts into these business interests and private equity that will help grow those retirement accounts, but invested in business interests. So this a bridge between the two that you will be able to grow your portfolio and be able to grow it much more quickly than traditional public equities that are earning historically 10 to 12%, maybe a little bit higher in the last couple of years. What we've seen in this year alone, the public equities have just been very variable, and so you can't rely on that.
Yeah. And I think one other thing I'll point out here is that mutual funds are included in here as well. So you could include that to be a part of your stock portfolio, but you'll see that even that amount, again, at 10 million is the max, and then it starts ever so slightly decreasing. And it's only the private business interests that continue to grow as net worth grows. And so that's where we want to allocate our efforts as well. And that's where we do allocate our efforts in terms of finding private businesses we can invest into for ourselves and on behalf of our investors. So sourcing opportunities is step one, right? We know now that investing into the private markets, private opportunities is the best way to do it. How do you do it though? Because these aren't publicly listed opportunities. How do you go about finding them? Step one, or not step one, but option one is network and proprietary deal flow. So here, this is relationships with operators, sponsors, the people who are actually on the ground executing the business plan. It could include fund managers as well, like ourselves, who allocate into a variety of these operators. Just networking with other investors is a great way to do it, and then industry insiders as well. So a lot of that is this entire slide, the theme is who do you know, basically, for lack of a better term. But that first one really highlights it. These are private relationships. Number two, broker and advisor networks. Those same brokers and advisors could likely be like sending those deals to you, but also the guy sitting right next to you. So there's no exclusive access or information asymmetry that you can act upon there. But it is still one way to get access to these opportunities. And lastly is industry conferences and events. So here you can meet the operators, the sponsors, the fund managers, the investors. That's a good way to get into the room. And another way to get into the room is just going to your local investing groups, your local real estate investing groups, financial planning groups, etc., things like that, as long as they have a focus on private markets and private investments.
And definitely rely on fund managers like ourselves, but also your broader network. They might have deals that you may not be privy to unless you go to these industry conferences or your advisors. Use those, use us as well. If you have deals that you want to run by us, have a high level due diligence, we're happy to take a look at those.
Great. So now that you've found an opportunity, the next step is
Oops,
how do
sorry.
you evaluate it? So investment criteria, strong unit economics, just in terms of returns, what kind of returns are we looking at? Defensible competitive moat, right? A lot of the basics of economics is supply and demand. As soon as whatever you're investing into goes is very high in supply, the prices are going to decrease. So what defensible competitive moat do you have that protects your investment? For example, a concrete case here is in real estate. If you have a ton of buildings that are being built all the time, real estate is not as valuable because the supply is just everywhere. Now, if you're in supply constrained markets like New York City, like the Bay Area, real estate prices are a lot higher there because the supply is so little. So that's an example of a defensible competitive moat is going into markets where the supply isn't increasing a lot or whatever you're investing into can't be easily replicated by itself. Real estate in general is a great option because it takes time to build more real estate. You have to go through zoning and regulations and approvals, and then the actual 2 to 3 years to actually build the building. That's a lot of upfront cost and a high barrier to entry that protects your investment. Experienced operator or management team, right? This is just making sure that you're working with the right people who've been doing this for a while. You would never get on a flight if the pilot told you that it was their first time flying. And so you shouldn't do the same thing here in terms of investing with someone when they tell you it's their first time investing either. As long as someone on the team has investment experience, that's what matters. Red flags to avoid over leveraged capital structure or floating rate debt. So debt is very important to keep an eye on, especially in real estate over the last 2, 3 years. We've seen that operators who've taken out high leverage, originally low floating rate debt back in 2021, 2020, now that they have to pay that debt off and that debt is floating rate, meaning the rates have increased, a lot of them are foreclosing on their properties or defaulting on their loans. Misaligned operator incentives. So basically here, you want to make sure that when you are looking at a deal, you're evaluating how does the operator or the person I'm investing with get paid. If they get paid upfront, all in, let's say they make 10% in year one, they don't have much incentive to really work hard the rest of the deal. On the other hand, if they're just getting paid 2% upfront and then 10% at the very end when the deal is successfully closed, then you're more confident that they have a vested interest in making sure that the deal succeeds. Declining market fundamentals or oversupply. We talked about the real estate case already, and so I won't go there. But for example, we're in oil and gas. So let's say, for example, that a lot of companies, now that oil prices are going higher, a lot of companies might come back online and start producing oil again. But even that takes time. Or countries, OPEC countries, might increase their output. So if supply then becomes too high, then prices will drop again. And really, the last few years, the reason prices have been low, especially in the last 12 to 18 months, is because supply was a little higher than demand was. And the growth outlook for the demand of oil and gas wasn't all that bullish. Now that unfortunately we're in a conflict and not a lot, but 20% of the world's oil supply is at risk in the Strait of Hormuz, that has now jumped prices up. So the six important filters that we look at when we're evaluating any investment, the six lens through which we evaluate any investment is returns. If I put $100,000 in, how much money am I going to get out? Number two is passive income. How much money am I going to get paid every year? That is important because if you can't sell when you want to sell, let's say it's a recession, you want to make sure that you can still hold the investment and that it still produces good returns for you. Because if you bank or if you count on the exit being your saving grace, that's not a great investment to be in, unless the returns are just that high on the exit. Tax benefits. How can we reduce our taxes that we're paying legally and passively, whether we're a W-2 employee or we're a business owner or we're an investor? That's something to keep in mind. Risk, is this a safe investment? Is this a riskier investment? Liquidity, how long is my money locked up for? In the stock market, your money's locked up for 0 seconds. You can buy and sell like a monkey all the time, anytime, 200 times a day. With private investments, your investment is locked up for between, on the low end, 3 months to 5, 7, 10 years on the very high end. That's important because if you need that investment, that cash, maybe for a down payment that's coming up, or if you plan on starting a family, you probably want to be careful about how long you're locking up your money for. So that's an important consideration. Lastly, altruism slash impact investing. There, you are not only evaluating an investment for its returns and risks and rewards, but also what general positive impact does it have on the world? Is it producing affordable housing? Is it producing clean energy, right? Things like that. So that's, and every investor is going to fall somewhere on the spectrum for each of these different filters. Some investors want really high returns, in which case they're willing to take really high risk. Other investors want not just medium returns, but very low risk. Some investors really want tax benefits. Some investors really want passive income and don't care about the growth story or the upside. So these are all important factors that we consider ourselves because our goal is that any investor who comes to us, whatever their financial objectives are, we have an investment that suits them, a private investment outside the stock market that suits them.
And I would add that one of the, I mean, these are mostly investment related. One of the call outs back to the experienced operator, we definitely align ourselves with operators that have the experience, have gone full cycle, that we know and trust. And hopefully, in the end, you will be able to know and trust them as well. And so just know that as much as the investments might fit our buy box, we also rely on the operator and make sure that we will trust the operator to usher their investment through to the end and deliver on their promises, if not over deliver.
So next, now that we have narrowed down which kinds of investments that we're looking for, once we find an investment that fits our buy box, our filters, how do we do due diligence on it? And what kind of financial metrics do we keep an eye out for? So for us, the financial metrics that we as fund managers look at are internal rate of return. And this is the easiest way to explain this is that it accounts for the time value of money when you are looking at investments that are returning cash to you on a different schedule. To give you an example that's more concrete, if you had two investments that both gave you 100% return, but one of them gave you 100% at the end of 5 years, and another one gave you 100% return in 2 years, which one would you choose? You would choose the 2 year one because, assuming all else is the same, because it's returning money back to you quicker. Even though at the end of the day, you're getting 100% return, one of them is giving it to you in just 2 years. And because these private investments have different cash flow schedules, it's important to look at internal rate of return. Real estate, for example, the returns are very low in the beginning. You might get 5% cash flow, 6% cash flow, 7, 8, 9. And then when you sell, an 80% profit, right? So it's small, big. Oil and gas is the opposite. Most of your returns are in the first few years typically, and then it decreases, right? It's big, small to like simplify it. So how you compare these two investments, the internal rate of return is how you compare it because it accounts not only for how much money you're receiving, but when you're receiving it. Equity multiple, a lot simpler. If you put in 100K, how much are you going to get out at the end of the investment? Is it 200K, 500K, etc.? All things considered. And then cash on cash return, that's your passive income, that's your cash flow. How much am I making on an annual basis as I'm invested into this opportunity? We obviously look at debt, which we mentioned before. We look at revenue growth and trajectory. What is the upside here? We look at EBITDA margins, right? Profit margins, entry valuation. So a lot of great investments comes down to just buying at the right time. I know there's a saying about time in the market rather than timing the market, but that more broadly applies to the stock market where things are uncertain. In real estate, you have much more opportunity to not necessarily time the market, but just find great deals. So if you can buy in at a discount, maybe 20% off what it would have sold on normal market rates, you're already in for a great investment because you have that 20% as a profit and as a buffer. Capital efficiency, return on invested capital, similar to the equity multiple concept. And again, coming back to that theme of debt and leverage and just being really careful about how the deal is structured. In terms of buy box and what we're looking for our investors, our clients, because we're scanning through many deals a year, probably 20 to 30 deals a year at least. And that is after the filter that the companies that we invest into have imposed. So the companies we invest into typically look at 100 deals a year, and they might bring not a year, but they might be looking at 200 or 300 deals a year. They bring two or three to us. And then even out of those two or three, we then do our own layer of due diligence to really pick the cream of the crop. So for private real estate, if it's an acquisition, meaning it's an existing building, and let's say it's a short-term opportunity, let's say less than 18 months, we're typically looking for a 20% IRR, internal rate of return. Cash flow isn't a big concern because we're just getting in and out, think fix and flips. And there's not a lot of tax benefits, again, because we're just getting in and out and we're not holding the property. Real estate acquisition, this is for a 4 to 5 year hold. Existing building, typically bigger scale, maybe a 100-unit apartment building. Here, we're looking at an 18% internal rate of return, and all of these are conservative metrics. Our goal at the end of the day is to underpromise and overdeliver. So 18% conservatively, 6% cash flow from day one. So every $100,000 invested, you can make $6,000 a year in passive income. And then tax benefits anywhere between typically 40 to 80% in depreciation losses. Private real estate development, a ground up build, if it's a 5 year hold period, again, because the risk is higher, we're typically looking for a 20% IRR or higher. We don't really invest in it for cash flow because the first 2 to 3 years, there's going to be no revenue. At that point, they're just doing the zoning, they're putting in the utilities, there's no actual units that's producing revenue. Tax benefits there, I would say similar range, 40 to 80%. Oil and gas, what we do there is we acquire non-operating working interests. The hold period is typically between 5 to 7 years on some of our more recent deals. In the past, we've just held in perpetuity, typically 20 years. There, internal rate of return, we're targeting an 18% return. That is not including the tax benefits that you get from investing into oil and gas, which is 80, but now with the big beautiful bill, it's more like 90%. I will also stop and mention here that our benchmark is your average stock market returns, which typically is achieving 10% on average, even in like internal rate of return, although it's not a great metric to quantify the stock market. 10% on average. More recently, with the bull run that we've had, it might be 12 or 13%, but our goal is to beat that for our investors. Private credit, if it's a short-term private lending opportunity, we target 10% annualized cash flow. And while that's a little bit lower than the stock market or on the same level, it's much less risk than the stock market as well, and much more stable. If it's a private credit or private lending opportunity for longer than a year, because our money is locked up for longer, we're going to demand a higher rate of return. So there we target a 15% return or higher. And with private lending, there are no tax benefits. It's just pure straight income. And so when you think about the previous six filters that we had, you'll see that for people who want passive income, private credit is the best for them because cash flow is the highest. For people who want tax benefits, oil and gas is the best because not only do you get 80 to 90% write-off, you can use that to offset W-2 income, which is powerful, which you cannot do typically with real estate. If you want growth, then real estate is great because you have the appreciation from real estate. And so those are some of the things that we consider, and that's why we're in the asset classes that we're in because each of them heavily focus on a different aspect of the six filters.
Yeah, and I would just add that one thing that I think we need to update on this chart is for oil and gas, there is cash flow, obviously. So besides the tax benefits, there is cash flow
Yeah.
in the whole period.
It's just not as consistent, and so that's why
Right.
originally we didn't put in we put in not applicable, but it's yeah. So thank you for the caveat there.
Yep. Give me one sec.
So the due diligence process, right? In terms of financial due diligence, we typically, as fund managers, are looking at 1 to 2 years of audited financials to make sure that they're not just cooking the books or that it's a Ponzi scheme. Quality of earnings analysis, we look at how they're earning their revenue, what their leverage is, what their expenses are, what their loan obligations are. Investment committee review, right now that's just me and John, but as we continue to scale, we will have people who just their full-time, the only thing they do is review deals day in and day out. And lastly, operational due diligence, right? Doing interviews and background checks on the company that you're investing with, doing reference calls with past investors, doing market and competitive landscape analysis. All of these are things that we're doing. And on our website, if you go to clivecap.com, you'll see that under the resources section, we have a due diligence checklist of 111 questions that we've put together that you should be asking companies that you invest with regarding the specific opportunities. And some of these are what we covered already. What is the debt structure? How is performance and incentives aligned? How are you being conservative on this opportunity? Tell me about an opportunity, just like a job interview. Tell me about an opportunity and investment that underperformed. What did you do? How did you learn from it, etc. So definitely go out on our website and check that list out for a more comprehensive guide on the due diligence process that we go through and all the different things that we evaluate.
The one thing you might be asking is with the proliferation of AI, are we using AI in the due diligence process? And definitively, yes, we are. You have to also, as with anything AI, you have to have a manual eye on the due diligence process, make sure you review everything yourself. But yes, we are using it. That's expediting this due diligence process immensely. And then once we have the initial feedback from the LLM, we will then review the results and make sure we understand them. But we'll also conduct a lot of these in-person or manual processes where we will do the interviews, we'll look at the financials. If we have the opportunity to walk the site, we'll walk the site in the case of on-site properties. So we will do those, and we'll speak to the management team, but AI is definitely helping.
So with all that we've discussed, how are we constructing our portfolios, our fund portfolio? We're diversifying across asset classes. As you've seen, we're in private lending, we're in real estate, we are in different types of real estate, which we'll go into in a couple of slides. We are in oil and gas, and we're constantly exploring new asset classes to expand into as well. We balance growth investments that have upside with income generating investments because there's always a trade-off between investments that are growth oriented and investments that are income oriented. You can't have your cake and eat it too, unfortunately. You can't have an investment that's paying you a lot from day one, but that also has upside, unless it has a lot of risk. So there's always something that you're giving up. We typically our investors are diversifying across 8 to 12 different investments. That is their goal. Each investment, typically our minimum is 50,000. So if you think about it, that means they've typically diversified between 400 to $600,000 of their portfolio with us. A $10 million fund approach. Our goal is to deploy capital over a 1 to 5 year period to target 2 to 4x returns in that 5 year period. The more stable components of that portfolio are real estate, are generating closer to 15 to 18% return, or private lending. But then you have investments that have more upside, like oil and gas or hedge funds, for example. And those returns that are slightly riskier with those investments are really what's going to drive your portfolio returns closer to that 4x range over 5 years. In terms of risk mitigation strategies, again, I would put this really under the due diligence process because we have a whole section on that 111 question checklist. But it's about reviewing the financial modeling, which is called the underwriting, the assumptions, looking at the deal structure, the debt structure, actively monitoring your portfolio performance, and defining an exit strategy. So never get into an investment without knowing how you're going to get out of it. So, quick comparison of investments here. We have residential real estate and the stock market, which everyone here is familiar with. But the three we focus on are private debt, oil and gas, and commercial real estate. And you'll see why here. The stock market, one of the big downsides there is even though the liquidity is high, the tax advantages are none. And the cash flow is very minimal as well. Your dividends in the stock market are very not high at all. Residential real estate is a step in the right direction because you're building up cash flow. You can take advantage of leverage. You have some tax advantages, but what you sacrifice there is liquidity because it's going to take you 1 to 3 months to sell your property. Moving to the left beyond that, private debt, we love, our investors love, as we'll see in a couple of slides, because of the cash flow and the liquidity. You get very solid returns on par, if not beating the stock market, without your capital being locked up for more than a year at times. On oil and gas, you'll see that we have the only thing we have three check boxes for anywhere in this table is for the tax advantages. And that's because oil and gas is the only asset class here on this screen where, regardless of your profession, what job you work, you can use it to offset your W-2 taxes. Obviously, speak with your CPA and standard disclaimers apply, but that is why our investors love oil and gas. It also is great for cash flow as well. And then all the way to the left, commercial real estate, you'll see is middle of the road for everything, right? Liquidity is the main downside, but tax advantages are great, equity buildup is great, leverage is great, responsible leverage, of course. And so you'll see that commercial real estate's a really good bet for all of the filters that we mentioned earlier. Not a lot of risk, great cash flow, great equity buildup, great tax advantages, or good tax advantages, I should say. Oil and gas, primarily for the tax advantages and the passive income. Private lending, primarily for the passive income. So each investment, each asset class that we're in serves a different purpose in a well-constructed portfolio.
The one thing you might be asking yourself if you're a traditional W-2 employee is like all my investments are locked up in, not locked up, but are in the public equity markets, the stock markets, or in my home. And like, how do I unlock that? We'll talk about that in a little bit, but essentially the idea is you can have a HELOC, you can have an S block for your stock market equities. And so you can take the cash that is sitting in those investments. You don't have to sell those investments, and then you can redeploy them in all these other private equity investments and opportunities. So that's one way that, like, I've personally done it myself. And you have to do it with consideration and mitigation of risk. But if you do it responsibly, you can definitely invest in private equity.
So here's how our portfolio at Clef Capital currently stands. Again, roughly $10 million, a little less, just a smidge at the time of this recording. But 52% of it, almost 53% of it, more than half is in oil and gas. So more than $5 million we have allocated into oil and gas. Again, because that's what our investors love. They get to pick and choose how they want to invest with us, and they have spoken that they want oil and gas because of the tax benefits and the passive income. Second is private lending, and that is because there we're achieving between 15 and 16% return in cash flow for them from day one, and their capital is only locked up for 1 year. So it's a great trade-off because you're beating the stock market, but your money's not locked up for 5 years like it is in a syndication. The third place is multifamily value add real estate. On the private debt, I should walk back. We've roughly allocated $2.8 million. In multifamily value add, we've roughly allocated $900,000, almost $1 million into multifamily value add. There, your capital is locked up for a longer period of time, but it is very safe and stable investment. Industrial real estate is even safer than multifamily value add and maybe a little too safe for our investors now that we're looking at this pie chart. And built to rent development is it's a risky bet sometimes because of what we talked about in development earlier. You don't see returns for 3 to 4 years. And so sometimes that's a tough pill to swallow, especially if it's your first time investing outside the stock market. So you'll see that we're diversified across all these asset classes. Not only that, but we're diversified geographically. You'll see that our oil and gas wells are located in North Dakota, Colorado. I think we have to update this map now because we have some in Wyoming and other states as well, Oklahoma. You'll see that we have industrial real estate a lot in the Midwest, but some in the Northeast as well, which we will again update, but multifamily in the Southeast, built to rent in the Southeast. It is through these private investments that we're able to diversify across the nation. That's a lot tougher to do when you're buying one single family rental at a time. Now to just go through some real world examples of the types of investments that we are allocating into. We've allocated into a mezzanine debt fund, for example, and these private credit investments are on the lower end of the risk spectrum. So there, mezzanine debt, we're achieving between a 16 to 18% return for our investors with just a 1 year lockup. On a liquid cash flow fund, it's a lower lockup, just 3 months. And because of that lower lockup, we're giving up returns. But that is between 9 and 11% on similar to the stock market, and it's a lot safer, but your capital's only locked up for 3 months. And the great things about these is that they're diversified across multiple borrowers, and there's only been one default across 1,000 plus loans that have been issued. And so these are the kinds of opportunities that we're looking at in private credit, for example. On the multifamily value add side, right? Here, depreciation, the tax benefits, we're looking at roughly 40%, which is standard for multifamily right now. And we're targeting an 18% internal rate of return, a 2x equity multiple, meaning if you put in 100K, you get 200K out. 8% cash on cash return, meaning on average, over the 5 year holding period, you're going to make $8,000 a year in passive income. We're buying at a discount, which we love. One of the big reasons we're able to achieve outsized returns, fixed rate debt to be conservative, even the rents that we're projecting are conservative, and we have rainy day funds in to the tune of $1 million in reserves in case we are over budget on anything. Again, this is lower risk as well, the multifamily value add. So the last example that we have is for oil and gas funds. So here, this is for strategic tax savings. For folks who need to reduce W-2 income, other sources of income, and they want passive income as well, but they're willing to sit through higher periods of risk when oil prices are really low or they move up and down very with high volatility. What makes it attractive, even though it is slightly higher risk, to offset that risk, you're getting an 80 to 90% year one tax deduction. So for those of us in some of the top tax brackets, that means you're saving now probably between 30 to 40%, meaning every $100,000 invested, you can claim 30 to $40,000 roughly in tax savings. On top of that, you have an additional 15% per year depletion allowance, which is an additional tax benefit, which we've talked about in our oil and gas episode, which you should definitely go check out. Diversified across multiple operators, multiple basins, meaning pockets of oil and gas formations, multiple wells, multiple states. It's inflation resistant, it's commodity backed, so it's a real asset. And the things we do to mitigate risk here primarily is invest with top tier companies who've drilled 1,000 plus wells. And what that allows us to do is benefit from their experience, but also because of their economies of scale, profitability is better, and oil can go as low as $40 a barrel, which is what it was during COVID when no one was traveling at all, and we would still be profitable. On top of that, typically target a 2 to 3x equity multiple, and you typically can expect a return of capital between 2 and 3 years after you invest. So that at a high level is how we currently are evaluating investments, and that's the approach that we took to get to a $10 million fund. Obviously, it's going to look somewhat different to get to $20 million, $30 million, etc., because we're constantly evaluating new opportunities, new strategies. But to stay up to date with how we're doing all of that, download our ebook here on our website, and it's called Investing Outside the Stock Market. That's the name of the ebook. Our website is clivecap.com, CLIVECAP.com. Check us out on YouTube as well. If you just search Clive Capital, you'll find our YouTube page. And we're also on all of your favorite podcast platforms. Our podcast name is Investing for Generational Wealth. We're up on Spotify, Apple Music, Pandora, iHeartRadio, all of it. So definitely go there, subscribe. We would appreciate your support there. And let us know what you want to learn more about. So for today, that's inside the minds of $10 million fund managers. My name is Keshav Kalor, founder and principal of Clive Capital, and my partner, John Lai.
Hello, and thanks to all of you who participated. I'm thrilled to be part of this, and we're just starting. As much as we've been around for years now, $10 million is just a start. We're getting to 20 million, and at some point, that scale affords us to look for different opportunities, much better opportunities for you. So, really excited to bring the next stage of our investment strategy to you, our investors, and then have you participate along the way.
Thank you everyone for listening, and until next time, can keep on investing for generational wealth.